This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Welcome back to the Three Wise Monkeys podcast, the podcast that's all about markets and investing. My name's Andrew Page, founder of strawman.com. Today I'm joined by Matt Joss from mattjoss.com.
Thank you, Andrew. Very happy to be here.
Matt, what are we talking about today?
Today we're talking about a conference that we went to a bit earlier in the week, Microcap Investing Conference, put on by Coffee Microcaps and Mark Tobin, a guy that organised that. So we've got a kind of a whirlwind episode, I think, just running through maybe up to a dozen companies. We'll see how we go for time. Small companies that are growing fast often.
Yeah, it was a really great conference. Thanks very much, Mark, for putting it on. We loved being there. It was also really great. We met a lot of investors and people in the industry I think we both really respect. It was great to run into Johnny Shapiro from the AFR.
Absolutely.
Tony Hansen from EGP Capital. Yep. It was really great to see him.
Greg Hoffman, good to meet that dude.
Yeah, really great to meet you, Greg. And way too many to mention here, but it was a really great event. But as you say, Matt, we have a lot of stuff to get through, so we're going to do a quick fire round on each of them. Yeah. And let's go pretty much in order that the conference went in order with. So what are we going to kick off with?
So let's kick off with Volpara. So Volpara is a company that provides software for analysing mammograms and breast density in particular. It's been growing exceptionally fast, but has also become, I guess, on valuation, something of a market darling. So a really interesting presentation from Ralph, the CEO, and a huge opportunity in front of them. So around 7% of US women are currently screened using their technology for breast cancer, and they're still a very small company, so a lot of opportunity there. Only about $6 million in recurring revenue though, and I think the price tag is about 50 times that, about $300 million market
53
cap.
according to my calculations.
There you go. So yeah, it looked really interesting to me. I guess the main question is valuation.
Yeah, it ticked a lot of boxes for me too. Very high percentage of recurring revenue, very big runway, seemingly a pretty big first mover advantage in that space. Very genuine value proposition to their customers as well. There's a litigation drive here as well. You don't want to sort of falsely diagnose anyone with this kind of thing. So that's really great. I think there's a huge amount of optionality with AI. Very much a buzzword at the moment. A lot of people talking about it. But one thing we know with AI that it's very good at is image recognition, and so this seems like a perfect candidate for that. So yeah, I was also very interested, Matt. I did notice that just on the same day that they released, that they were at the conference, they said that they'd exceeded their guidance. So annual recurring revenue was up 86%. They said it was only going to be only 85, and it was actually 7.1% of US women screened. So
so not a huge beat though.
Not a huge beat, but
nice.
A very lofty target, and they beat that. So very excited, but yeah, as you say, 160% gain in the share price so far over the last 12 months makes it a little bit pricey.
Yeah, maybe one we'll come back to in more detail, I'm sure, in the podcast.
Yeah, for sure. BlackWall was the other one. So BlackWall, these guys probably best known for Watso, which are these collaborative workspace companies. Think WeWork. In fact, WeWork was mentioned more than a few times by the CEO, and really said that they've done wonders in terms of promoting the whole collaborative workspace scene, doing a lot of marketing for them, which I guess is one way to put it.
It's a positive way to spin having a huge, well-funded competitor.
Yeah, very much so. They also do property development, but I think their main sort of point of difference was that they tried to go outside of CBD locations where the economics tend to be a little bit better. They get better yields. I think this is interesting. I definitely do, but I'm really worried about these kinds of businesses. I used to be quite familiar with ServCorp, actually the guys who pioneered this kind of space well before anyone heard of WeWork. And what you have here is that you have these pretty high fixed costs, and it only takes a very small movement in occupancy, in the rents that you charge, and profit is absolutely crushed. So for me, and there's no barriers to entry here. This is just lease arbitrage, right? You and I could buy a commercial property, fit it out with some desks, and rent it out.
Should we do it?
No, I'm not going to say.
Too much admin, too much hassle.
Enough massive competition as well. True. So on one hand, you look at it, 4.5% yield, PE of 13, very good thematic. It's very sexy right now. I would be very interested in this at the bottom of the cycle. So
Yeah.
if and when a recession comes, this thing's going to get bombed out. I think that is the time that you buy it.
Yeah, so one point that was interesting, he kind of spoke about why this is happening now. People kind of see it as like why people are using these cooperative workspaces. He made the point, which was interesting, which was a lot of it was just a shift away from paper. So once you move away from needing paper for everything, then you don't need a filing cabinet. You don't need a fixed office that you lock up at night. Suddenly everything's in the cloud and you can do it anywhere, which is an interesting angle. Like a lot of it had been driven. People talk about startup culture, but that's an interesting thing that most businesses don't need that space.
I agree.
But he kind of made the point that a lot of businesses still will. It's not going to be everyone going and working in these spaces. And so I kind of found them like, it seems to be quite efficiently run. They have a good knowledge of the industry. The multiple is light years away from WeWork. Like every other competitor WeWork has, WeWork's on its own little bubble.
That's a whole other topic for another day.
Yeah, exactly. For me, though, I think the question I'd be asking is, what will happen during the GFC? Same point you raised, because they're so sensitive to occupancy. And I imagine these are the first ones to go. Like the little startup that's not doing too well shuts up shop during the GFC. Yeah. Suddenly, it's not so appealing. So I imagine that's like the first rung of tightening.
Having said, we've got to move on, but having said that, what's interesting is well-funded, well-capitalized businesses in this space. I think for the long-term investor, big economic wipeout, it's actually great for them because they're not beholden to the bank. All of a sudden they can pick up a bunch of property super, super cheap. And we've seen this with Servcorp in the past as well. So, but it's a pass for me at the moment.
Which brings us to SkyFi, so ticker code SKF. So this is a super interesting company to me. I'd looked at it before actually a couple of times. So the kind of core product was providing free Wi-Fi to shopping malls and restaurants and everything else.
Airports are the big
so,
one.
So you log into that free Wi-Fi and they track you. there is a trade-off.
Great, where do I sign up?
You normally click that button, accept. Yeah. And that's the kind of software and service that they provide. So it is quite useful to a retailer or anyone operating a store to have that data on their customers. So normally you could do it just from camera or something else, but this you have an actual device. You can probably pull a lot of other data off that device and kind of track them all the way through to point of sale. So they've integrated a lot more stuff over the last few years. I kind of thought of starting Wi-Fi as a bit, how far has that got to go? But they've started adding more and more points to their software suite. So connecting with all of the back-end systems of the retail or the shop owner.
Point of sale
systems, engagement and marketing tools. So bringing a lot of data sources, which is important. And you can do they showed some cool stuff with like heat maps and showing how a customer moves, where the problem points are.
Data is their product, right?
Data's their product, yeah.
And it's very valuable to stadiums and airports and that. Where are people going? Where are they shopping? What are they doing? What are their habits? What messaging can we send them? It's super, super valuable stuff.
And they're in a similar space to another company I'll be talking about in a few weeks and releasing a write-up on, which I'm super interested in. So that's always interesting to talk to a competitor. I think couple of points. So I was going to ask this question of them and someone else beat me to it, which is, what does 5G do to your business? So when people don't need to use a Wi-Fi in stores because your 5G coverage is so strong, why would you bother logging on to Wi-Fi? I think that's an important thing. They gave some answer there, kind of branching out from being, it's in their name, SkyFi. They're moving away from just Wi-Fi, but that's something to consider for me.
I'm the same, and again, it's always a danger as an investor to put your own experience and habits, and expand that out to everyone else. But I just never do that free Wi-Fi because I get everything I need on I'm on 4G, right? Yeah. I've never found, and plus, there's privacy concerns and the rest of it. Look, interesting. I'll give listeners some numbers. It's on about 6 times sales, but revenue was nearly doubled last year. High levels of recurring revenue, 38% of revenue is offshore. They are operating profit positive, which is really nice. Another nice thing as well, Thorny Investments, who a lot of investors will know, they have a pretty big chunk in that, which is it's a heuristic, but it's those guys tend to look at it pretty closely. But I'm with you, man. I think it looks very interesting, but needs to do a lot more work on that. Here's another one. So we've sort of talked about there's some software companies and then a bit of property, but Kangaroo Island Plantation.
Not the sexiest company, but different to the couple.
But it was a great presentation.
Yeah, it was really good.
The ticker code is KPT. And the CEO started off with a picture of Stephen Bradbury and was like, where's this going? And it was basically saying that, look, in Australia, listed plantation companies don't have, think Timbercorp, think Quintus, think these companies that have all basically gone belly up and just torched a whole bunch of shareholder capital along the way. And he sort of said, well, we're the Stephen Bradbury, we're the ones still standing.
I love that because he just addressed it right up front.
The elephant
like
in
it's
the
the main
room.
thing. Everyone's thinking, oh, here we go. Like, yeah.
And I got to admit, when he got up, I was like, I'm just going to start playing on my phone because I'm never going to invest in a company like this. But I got very interested. They own the land. It's not a managed investment scheme, which is very different. They're actually well on their way. They've actually got harvestable material right now. There's a thematic out there where there's rising demand for wood chip, but there's very limited supply. And the supply response, so if the demand for coal or oil goes up drastically, the supply response is really quick. With timber, it's really slow because it takes, I think he mentioned 12 to 15 years minimum to sort of get a lot of these plantations to maturity. Also, a lot of that timber, I think all of the timber, correct me if I'm wrong, Matt, but I think all of the timber was pre-sold too on volume.
Yeah.
Not on price,
Yeah.
Which is great. So even if you assume at current prices, and there's no increase in price, he was sort of saying they'll be earning about $20 to $30 million per year in cash, which is really nice. That's about 3 years out before they do that, which is about 5 times. That means they're currently trading on about 5 times that at this point in time.
Yeah, I guess a few things to keep in mind. There's a wharf development that's needed to get this timber off the island. So
a big bottleneck.
Yeah,
there.
and so they have to get environmental approval for that. Still waiting for that to come down. They seem optimistic about it and have seem to be good reasons to be, but it is it's not a guaranteed $30 million in a few years' time by any means.
What was interesting about that was that he sort of, it might have been him or Tony was sort of saying, look, at 95, the market's sort of looking at it as a 50-50 proposition, but they were sort of saying the stage it's head, it's probably very, very likely. But what was interesting, assume it doesn't, right? The trees just continue to grow in the meantime. There's a second wharf site. There are other options, so it delays things. The market's not going to react well to it, but it's not like the whole thing is a bust after that. So look, at a good discount to their net tangible assets. And by the way, when they're calculating NTA, just to get a little geeky here for a second, they're using a very, very conservative discount rate, 12% versus about 6% that what typically gets used in the industry. So that, and directors own, I think, 10 to 15% of the company.
Honestly, listening to it, it was kind of annoying for me because I was hoping it's like not in my wheelhouse to invest in a timber company, but I was actually getting interested. So I'm like, do I have to go like research this whole new thing? Like I have to learn about timber now. But no, it was cool. The other point that I thought was interesting, he talked about how in other parts of the world, a lot of big funds will have like 4 to 8% of their investments in timber, like think superannuation funds. So it could be something that develops over time in Australia. It seems to align well with what a fund's doing, thinking very long term.
One wild quick thing too. He made a point at the start too. He's like you think about resource companies and most of the problems, issues that they face is, well, unlike most resource companies, our resources grow over time and then they renew as well. So that doesn't happen with a coal mine. It doesn't renew itself. Plus they know exactly the amount of resources that they've got. There's not a geological estimation that's involved as well. So it was one of the more surprising presentations. Locality planning was next on the agenda, and the ASX ticker here is LPE, founder-led business involved in electricity supply. So they're a utility essentially, but they operate in this niche area of residential strata. And so the value, by the way, they're not generators, of course, they buy it off the national energy market, bit of solar, but basically they offer their customers a bit of a discount by bundling all of these units together, giving them a bit of a better price. They don't take any pricing risk because they just apply a margin to what they're paying. So the value proposition is it's a very good experience. You get a really good price. They tend to have very loyal customers. Their customers tend to be the ones that promote them the most. They've had really great customer growth. I'll direct listeners to some of their slide decks. 30% growth in customers in just the current year. Revenue up 53% in the most recent half. Still loss-making. It is a capital-intensive business. They did get a bunch of funding or a funding facility from BlackRock, which should help them continue to grow. I don't know what to think about this one. What do you think about this one?
It didn't grab me. It's not my normal wheelhouse, so I didn't take too many notes. I'd be interested to hear like what you think is capital intensive. Is there like equipment that they need to do?
There was a big part of the presentation he was talking about installing solar panels on roofs and that kind of stuff. So it's those I think people feel very good about that kind of stuff as well. And it's not something that's easy to do if you're in a residential block to sort of get the strata to agree on that and set it all up. They kind of come in and solve that problem. But yeah, it is a bit of capital intensity.
Yeah, so for me, it's not an industry I like to go into where you're in a reseller relationship. They can do really well. So like there's plenty of people that will invest in them, but there's also often a crash risk where the person you're reselling just says no or chooses to exercise their power, which can never happen. Sometimes it can happen. So for that reason, I just kind of avoid that sector. But
there is a lot of inertia in that. Like no one likes to think about their electricity. Who cares? You know, well, I couldn't even tell you. He made the point, you know, name your electricity provider. I was like, actually, I'm not even sure who mine is. So there is a lot of inertia in there. Having said that, I tried to convince myself of the benefits of another company in this space called ERM Power. I'll just say it didn't work out well for me. And, you know, so it is a very, very tough space. Let's move on.
Yeah, let's move on. So the next company I believe was XRef, ticker was XF1. Very interesting company. So provides a software platform which allows easy reference checking for new hires. So they basically provide a very easy way to get a list of references from a candidate, send an email out to all of those references, and provide an online form for them to provide a reference. So it's really interesting because it is, if you've ever done hiring, if you've ever gone through that, it can be a huge bureaucratic nightmare to deal with it all.
Is the technical term.
And there's a lot of biases, honestly. If you're calling up references to ask them what's going on, you only get certain people on the phone, and then they might want to say something nice. Whereas I think there's something to be said for like a more neutral way of collecting it all and analyzing it, and you can have a whole lot of fields and make sure they get ticked every time, which you might forget if you're on a conversation.
And you can cross again. This is a company that there's a positive flywheel effect of the more data that they have, the more sort of nodes in the network, the more you can cross-reference a lot of data as well. Plus, they plug in with working with children checks and police checks and all this other kind of stuff, which is nice. Yeah,
so a lot of good stuff. It's just kind of floating around of break even, but that isn't new. So I guess it was interesting in the questions CEO kind of pointed out, like, what are some of the risks. He talked about how I guess the journey to being a public company, where I think in the past some of the expectations got ahead of themselves and the share price has been fairly kind of treading water for a couple of years. Interesting stuff for me is if they're talking about a new way of selling to customers, which is more kind of programmatic and self-serve, which is always really interesting to me. It's something I like to look at.
That was amazing. What was he talking about? The sales cycle was what?
I think it had previously been, I want to say 90 days. I think I had it somewhere.
Yeah, that sounds about right.
Yeah, about 90 days. He got it down to 33 days now. But then they're talking about getting it down to effectively a day, where you just say, you hear about them, you go and sign up and start making some use of it. And there's
it's
different
like getting
levels.
a zero subscription if you're a small business, kind of.
There's different levels. So the one day one would be someone literally just trialing and spending maybe $5. I don't know. But then then they might be an opportunity to upsell. So that's very interesting to me. It's not cheap, but unfortunately, like most things at the conference, everything is on big multiples of sales now. Thinking back a few years, it was multiples of earnings. I remember you and I going to a microcap conference and talking about it's on 25 times earnings. I don't know about this one.
What you'd give these days, right?
Which isn't the case anymore. But yeah, interesting company and one I'll be looking into.
I agree. Very interesting. Very slick presentation. I should say he was one of the more animated, more professional kind of presenters there. I don't know if that's actually a good thing.
It's a 50-50 for me as well.
Do you know? The more slick the presentation, sometimes I'm a little bit more concerned. But look, a lot of I'll just agree with everything that you kind of said there. Again, a lot of the things you like to see, 94% retention, very good. Really interesting in their business models, they receive the cash up front. So they sell credits to their customer, and the customer then uses the credits after the fact. So you get to keep all the cash up front, which is really, really nice.
It's a cool idea for hacking growth to kind of fund yourself, which is cool.
And then once the customer's got those credits, it's like casino chips. It doesn't really feel like you're spending money, I suppose. So maybe there's something in that. Price to sales on my numbers, I did this on the back of the napkin while I was there, but I think it was about 16 or so. But no debt, $11 million cash in the bank, growing very fast, revenue doubled in the last half. Definitely one I'm going to take a closer look at. Yeah, the next company was Kelly Partners. The ASX ticker is KPG. This is another one that's straight off the bat not interested. Pull the phone out, start playing Clash of Clans. I'm just going to go to sleep for the next little while. But it did surprise me.
Poor accountants, man.
So the business is a roll up of accounting practices of SME, small to medium enterprise accounting practices. not only is that ho-hum as a business, but it's also, we know the association around roll-up companies.
Yeah, so it's like double boring squared.
Boring and like red flag kind of is what I would say. Having said that, I apologize.
Brett Kelly?
Brett Kelly, yes. The founder, founded in 2006, listed in 2017. It is Sydney focused, 15 locations around Sydney. 20 acquisitions, I think, or so that they will have by the end of this year since inception. Half of the growth has been acquired and half of the growth has been organic. So a lot of these models, the value prop is, hey, come into our network. We're going to run it like a proper business. You're going to be able to outsource all the boring stuff that you don't want to have to do. We will take care of that. We're going to give you half of the equity, so you've still got skin in the game. There is a huge cohort. There's thousands and thousands of these small to medium enterprise accounting practices with basically when that person retires, that's it, right? It's not a business that's easy to sell because it's a services relationship based one. So this gives them an exit. It takes a lot of the annoyance out of their lives.
An exit where they often keep working, right? So they might sell and achieve a lot, and then they'll stick with it. As Brett Kelly pointed out, these are creatures of habit. Someone asked, what's to stop them going and doing that and then starting up again? And what do you say? There's carrot people and stick people, and I think as most accountants are stick people, and that they're moving away from pain and the hassle of dealing with this, versus someone who's chasing the carrots of like being greedy and wanting to go out and maximize. So it's an interesting point, and yeah.
And I guess so. He got some interesting questions at the end. He was an accountant, right? He fired back a whole bunch of numbers and talking about recent acquisitions. Like, wow, this guy has really got his head around the model. So I am very cautious of roll-ups, but there is one thing that I think is interesting about roll-ups is that even if they fail, they tend to work very well in the early stages. So this is 20, let's call it 20 odd practices just in the Sydney region. So if let's say this thing ultimately doesn't work, it's only going to, let's say they do 10 acquisitions next year and they've got a good record so far of integrating and doing that rather well. That is going to significantly move the dial. And he said himself, look, we're targeting 5% growth in operating profit per year. We think we'll easily beat that. But even on those numbers, again, my back of the napkin kind of calculation made it seem like quite compelling. So well outside of my style box, but it's something that I was surprised that I was interested at all.
Yeah, it's tricky because they work well in the early stages, but we only know the early stages because we relate it to when they crash. So
yes,
it's
true.
Like walking a tightrope worked well in those early stages until he fell off.
Until he fell.
So it's hard to know.
It's
hard to know exactly like where the end point is for them. But yeah, at a certain point, it starts becoming very hard. I think to Andrew's point, they are still very early in the potential size of the market. They're not hitting any limits there. So
another thing just to watch is that these, and he was at pains to point this out. This is very, very lumpy revenue. I won't get into the accounting reasons for it, work in progress and the rest of it, but it's not something you should expect as a nice, consistent growth in earnings. It's going to be great one half, not so great the next, and that's just the nature of the business.
So next up was Envirosuite. I don't know if anyone's heard of this one. Andrew definitely doesn't know what this is.
Envirosuite.
EVS. So I don't think we need to talk through this one too much.
Whoa, Matt. Let's not be too hasty.
So it's an interesting company.
I think you're right, dude. I think our listeners have heard it to death. There's multiple episodes on it, on the series. Go back and check it out. Peter didn't have any new information to disclose there, but it seems to me as though they're just getting it done. I think I mentioned last time we talked about it, as much as I've sort of been an advocate for it, it's far harder to, from an investment point of view. From a business point of view, things are as good as they've ever been, but from an investment point of view, it's 17 odd cents or something. The value prop is very, very different than what it was at 8 cents. So I'm more cautious. And I should say, just for full disclosure, I did sell about a quarter of my holdings a week or two ago.
Yeah. I think he was right before lunch, so it was like a tough time for me to focus as well.
It's always hard. Yeah.
Tough moment. So cool. Good, interesting one to keep an eye on.
The next one, ocean-grown abalone, ASX code OGA. These guys are aquaculture. They grow abalone, as the name suggests.
In the ocean.
Which
is important.
Where they grow. So, look, the investment case here is one of, they sell pretty much all of it to Asia, pretty much to China, very big growing market. They have a very big appetite for not just abalone.
Have you had abalone? Have you eaten abalone?
Not a fan.
I love it.
Do you?
Yeah, but you have to get the right stuff. So in New Zealand it's called pawa, and there's two ways people have had it. One is like grinding it up and to make fritters out of it, which can be good but can be very chewy.
So if it's very heavily deep fried, I could probably handle it.
Yeah. Or if they're very young, which is now illegal in New Zealand because of the fishery stuff, they can be delicious and soft. And I think that this is kind of what they're targeting, is for like people to eat it. And it's like seen as like a luxury in China.
So yeah, and the brand here is Brand Australia. Well, we know that through vitamins and through milk and all of the very well covered kind of stuff. So they have laid, what do you say, 3 kilometers of these on
maybe 20. It was
huge.
huge.
Sorry, yeah, it was
20
huge.
kilometers. Yeah,
Absolutely
it's huge.
Phenomenal.
So it sounded like it just started him chucking down these concrete things. He used to go out collecting them in the ocean and then realized, hey, why don't we put down a habitat in this perfect area, put down some concrete blocks, started working. Now they've just done this on scale. So it seemed actually like quite a cool story. Seemed like a guy who was very into it and had done it all himself.
Raised some money. They've now got a big processing plant there. So they're trying to move into this vertical integration. You know, I think he said something about, look, $17 a kilo cost for them for every kilo of abalone they get, and they sell that for 40 kilos as well.
$40 a kilo, was it?
$40 a kilo. So it's not a bad margin. But look, aquaculture, there are huge risks there. There's disease, there's poaching, there's all other kinds of things.
They are, I guess, one distinction, they are doing almost all their business currently in the ocean.
Yes.
So that maybe reduces some of the problems with typical aquaculture.
Yeah.
But that's a new expansion, is planning to do onshore aquaculture of this, which to me, it's not ocean grown, so it hurts a brand, which I asked the CEO about. Yeah. He seemed pretty defensive about it, because I'm like, does that hurt your brand? He said no, because it's Brand Australia, it's not ocean grown brand.
Right, maybe a bit of a halo from the other stuff that they do.
He's probably right, but it's not the same kind of thing that they've been doing.
So it was interesting enough. The wild catch out in the wild is falling. There's a little bit of a black market out there, as you sort of hinted at before, but that's like really on the fringes. It's not really affecting global supply demand kind of stuff. Again, outside of my style box, I may or may not take a closer look at it. What do you think?
Yeah, I guess it's harder to get excited than a software company that's grown all over the world. But it seemed like, if that's kind of something that interests you, it seemed like an interesting story, and he seemed super passionate.
I'm very jealous of his office, though. He's just
going out on the boat.
Yeah, they're off the coast of WA. It's just absolutely beautiful water. It sounded like a really, really great lifestyle, and the CEO is really passionate and believer in what they do. So yeah, I wish them the best of luck.
So next up was AuMake, a Daigou retailer, so selling to Daigou, and the ticker code for that was...
Yeah, I think it was AU8.
AU8, interesting.
Lucky
choice.
8.
Lucky number 8.
Very auspicious number for the Chinese.
Yeah.
So it's no coincidence, I think, that there is an 8 in the ticker.
Anyway, there's probably too many 8s in tickers these days, but this one I guess makes sense. At least it's focused on Daigou and China. So the idea is they have these retail shops, the Chinese Daigou. So Daigou there's hundreds of thousands of them in Australia who are people, Chinese who live in Australia and send stuff back to China and sell it often through WeChat, a mobile messaging app.
It's a phenomenal cottage industry.
Yeah, it's a huge multi-billion-dollar cottage industry. It's been responsible for the rise of brands like Bellamy's and A2 Milk. A lot of their sales, they kind of drove the brand into China, and A2's now trying to
and Swiss,
directly expand. But so their AuMake is trying to be the retailer of choice for these Daigou, so they don't have to go into Woolworths. They go to AuMake, and they, I guess they have a lot of stuff in Chinese. They offer a shipping service direct out of the store.
They really just make it easy.
Yeah. To me, I was pretty skeptical of this one. So the multiples and the business is still loss making. I kind of think for the model that they're doing, I'd prefer to see profit at a store level. Like there's to me, not a huge reason there should be big overheads for this. They're talking about getting into profitability, but
although their mature existing store network was very profitable, I think he made that point. I haven't checked on it, but I think that's the point he made.
Yeah, I think there was a lot of talk in the presentation about like gross profit versus net, but I'd have to go back through. But a big lot of costs that they're managing. I guess. Yeah, for me, the other kind of bigger question is just how sustainable this is, how much growth there is, whether Daigou really prefer to use them versus over others. Some of the advantages they talked about was that they're the best at bringing in new stuff, so whatever the new hot thing is for Daigou. So it's an interesting one. For me, I was a bit cautious of the whole kind of model, I guess.
As an investor, I'm not afraid to admit my vast and almost unending limitations, and I kind of put it in this basket. I like, as a conceptual thing, it seems, I mean, capitalism is built around, servicing the demand of consumers. So there was this massive market inefficiency where there was a huge demand for stuff in China that just was not being delivered direct from the companies. And so the Daigou sprung up, very entrepreneurial, and solved that problem. I just, when I look out 5 or 10 years, I mean, is that, when you hear Blackmore's talk, when you hear A2 talk, they're all going direct. So to me, there's probably a very good reason, and there are very big cultural differences, and there are a huge regulatory problem. I get all of that, but just at a large scale, I really struggle to understand how this inefficiency is going to persist for so long. He talked also about how these very entrepreneurial, very smart Daigou have got this WeChat platform that they can compare prices, and yet he's talking about their margins being so much better than everywhere else. Well, if everyone's comparing prices, and how are you able to charge?
How does that last?
I don't get that.
Yeah.
There's probably good reasons, but for me, it's just something it's too hard basket.
Yeah.
Next one was TruScreen. This was an interesting one as well. Let me get the ticker code.
Yeah, so the ticker is TRU, but they're listed on the New Zealand exchange,
Pass.
which is the NZX,
Hard pass.
which is where all the best companies, I think, came from. Xero, like a lot of great companies, before they kind of dilute themselves into Australia. And not saying they slow down a bit and they come to Australia. They stop growing. So anyway, listed on the NZX, which is interesting and was my first big question.
Why?
And it seemed to be that they had some original investors with some wealthy private investors based in New Zealand. So that was part of the promise.
Pushpay started that way, didn't it?
Pushpay was started, but they also have the office in New Zealand. So the difference here is TruScreen's an entirely Australian company, just listed in New Zealand, which is quite unusual.
Where the backers were. Okay.
Yeah.
They are intending to list on the ASX later this year, though.
But let's get into what they do. So give us a rundown.
Well, they do. They've got a little medical device which scans, detects cervical cancer, and it's really aimed at developing markets. So it's a razor and blade model. You buy the unit. But you have these disposable probes that are used in the procedure. It's about $25 Australian for each procedure. It's very, very cost effective. So China is their biggest market, but there's East Africa, there's South America, there's India. There's an absolutely phenomenal market, and there's a very big need. A lot of people will kind of think of, well, what about Gardasil, which is the vaccine for cervical cancer? That only covers 70% of them, and frankly, in these other parts of the world, that vaccine isn't around. So this is going to be around for a long time. It's a huge problem. They seem to have a really great solution for it.
Yeah, it's an interesting one for me. I have to make up my mind on just the business model. So they're targeting emerging markets because they don't have a good existing cervical screening program, but they also need funding for their devices to be sold. So the idea is that it's much cheaper to roll out their devices than have a full screening program and all the lab testing costs that goes with that. However, you still need to have the governments there care enough and have funding enough to provide access for this device in the first place. So they answered that question. It's one of the early things that came up. They kind of talked about it as being advantageous compared to other screening programs, but it is something to keep in mind, I think.
Yeah, look, the sales have been growing very strong. Big addressable market, sales going very strong. You can feel good about what they do. At the same time, not yet profitable. It seems to me as they're almost certainly going to need to raise at some point again in the future. Working in developing markets are huge, and you see the occasional company talk about, if only we sell this to, if every person in China bought this, how rich would we be? But they're very, very difficult markets. There's a lot of corruption, I suppose.
And this is only 7 employees, this business. So it's currently got about 2 million in revenue, but still very small. They've outsourced a lot of that, I think. So it's not, there's people working for them that aren't. Obviously, it's not just 7 people making the device in the backyard shed. But yeah, so it's interesting. In some ways, I like that it's going to be very light, the business itself. It's focusing on the IP, but it is still very small. And so it is pretty small.
It is pretty speculative. It is loss making. I really, really wish them best of luck because they are doing great stuff out there. I might pop it on a watch list and come back in another 6-12 months, see how they're progressing. There was more than a few little parallels I did notice with Nanosonic, which is also the razor and blade model, which made my ears pick up, but a little early stage for me anyway.
So the last one is Adalta, ticker code 1AD. This is the last company to present, but honestly, it was pretty far outside my wheelhouse, and I tend to just not look at companies where I know that there's no chance that I'm going to be investing, so I don't have too many good notes on this one.
I took a few notes. I've got a bit of a background in biology and science, so I was kind of interested from that kind of standpoint.
You're a microbiologist, right?
Well, there's a degree that says that's true, but I've never actually worked in the field, and it's probably moved on so far now as to be a joke with my qualifications. But anyway, this is a drug development company, but from an investor standpoint, I can tell you that's an instant turn off. Again, lots of great stuff is done in this space, a very necessary part, does wonders for us as a society, but it is where shareholder capital goes to die. It is like a mining company in a lot of ways, and we've talked about some of our reasons why we don't like this. They're working on a drug that's for fibrosis. Again, won't get into the detail for that, but they've got an early stage candidate or a few candidate drugs there. What was interesting about this, I thought their business model was interesting, is because rather than sort of develop the drug, work out the manufacturing, and then pass through all the various phase 1, phase 2, phase 3 and get to market, they are looking just to get it to phase 1 and then sell it to the big biotechs, which is really interesting because there's plenty of stuff that goes right through most checks and then dies at the 11th hour. And so they obviously, if it ended up working, they'd probably miss out on a lot, but they get the money in their hand now. It's bird in the hand versus 2 in the bush. So Sam Cobb, the CEO, she gave a great presentation. She's been working with this to try and commercialize it for a long time. Really smart person, really trying to do good things, just hyper risky. They've got more than one in the pipeline, but I think there's really one that they're sort of resting most of their hopes are on in the short term. So this is the kind of investment that if it works at the current price, you will make 20 bags, 50 bags, 100 bags. It'll be insanely good returns. But it might be that it's a 95% chance that it doesn't get there, in which case the losses could be quite significant.
Yeah, I think you sum it up well with a percentage. And someone in the audience asked, what would make this drug be more successful than the statistical average? Which I think is just such a good way to think about these things. If you're investing in this space, I think you should have a handle on what is the statistical average chance that any drug gets through. And do I think is there any particular unique attributes that will make this one more likely than others? And the CEO gave some reasonable sounding to me reasons.
Totally
it's not
reasonable.
my space.
Yeah.
And the other one is just you don't have to invest in everything. I don't even look at biotech because it's too much above my kind of skill set. And
well, a CSL might, if I could interrupt, might be different for you because that is an established one with a bunch of patents and known products. That is very, very different to a very early stage.
100%. So I think the way I think about it is it possible for me to get my circle of competence enough to understand this? And emerging biotechs, no one understands it because it's literally new knowledge. I thought about this a lot. It's something that
in the scientific community, everything is so specialized now that even there'll be specialists in the drug development industry who have no idea about fibrosis and the effectiveness of this drug.
Yeah, and even in the industry, no one knows because it's going through a trial. This is on the cutting edge. So, but then to your point, whereas others like CSL are very big, you can value them on cash flows and have a little bit of a valuation might be down to some of these newer things. But you've got to handicap the odds. You've got to have a way to do that, and not for me.
I think it's one thing just before we end on Adalta, and it is something that is always going to be appealing to a certain segment of investors because it is so sexy. The market is so huge. And when you have a massive informational disadvantage, because unless you are an expert in fibrosis and drug development, you've got 3 PhDs in genetics and biotechnology, it's not going to make you. There's no way for you to validate. If we're talking baby formula, I can get close to baby formula. I can figure out who's
some
buying.
baby formula is almost a medical miracle, like A2 milk, right?
Oh, you're trying to trigger me now. But do you know what I mean? And so,
Yeah.
I would sort of say, as an investor who doesn't have specialty in this space, just be very, very, very careful, because they all sound fantastic. But
Yeah.
again, the statistics will tell you.
Doesn't
just
have to be
how
your
good you are.
capital. I'm very happy that people are funding drug
fantastic.
development. Doesn't have to be my capital. Doesn't have to be yours if you're not up to it.
So, man, that was a really
Wow, we got through a lot.
we got
I feel like
through
it was
a lot.
good.
Yeah, we did. So, look, I hope you found that valuable. Again, thanks, Mark Tobin, for putting on such a great event. Wish you best of luck with that and Coffee Microcaps. I'll link to a bunch of useful stuff in the show notes if you want to chase any of this up. But Matt, Easter is upon us.
Yes.
And we are going to take a little bit of a break.
Yep.
So
I'm heading back to New Zealand next week, and you're heading somewhere. And
we're going to Hamilton Island.
Very
actually.
nice, very nice.
So we're going to take a bit of a break. We thought of how we could do this remotely. It was just all a little bit too hard. But we will be back at some point in the near future, and we can't wait to have you join us at that point.
Yep. Look forward to talking to you in a few weeks.
That's it for now. Talk to you soon.
Thanks.